Fernando's question goes back to our conversation for Luca in the beginning. He said, for the put backspread ratio, is it convenient to mount the structure starting in correspondence of the worst point of the dead zone? And this, wherever the line goes off, you get moving the payoff. Fernando, sure. Okay, what Fernando was talking about is, I got to add custom spreads. I can't believe I don't have that on our webinar account. We usually use that tool on the webinar 10 times more than anything else. So let's get back to our custom spread tool. There we go. Now the put ratio backspread I showed earlier in our discussion for Luca. We were just going 14 days out, remember? And I was, with the stock at 226, I was buying two 225 puts, which are very close to at the money. Right, Fernando? But remember, in this case, this is going to cost me let's be nice, let's call it 345 midpoint times 2, which is equal to what? 690. Okay, so remember what I said about the structure. Where is that pivot going to be, Fernando? What Fernando means is, when you structure it, isn't it better to have this point right where the stock is currently trading, so there's bound to be some movement in one direction or the other? In theory, yes. In reality, no. It's not no. You want to do that, Fernando. You're absolutely right. But in reality, it's not going to happen. Why? Because you're going to have to structure it a different way. See, I took the at the money, which would be a cost at 690. To get that 690 premium, I'm up to 235. Okay, so sure, I sell the 2 here. Oh, that's a weird bid ask. Ignore that one. Let's just say even the 232 and a half. I'm sorry, 665 to 670. Let's call that easily 710, 720. Okay, so you're thinking right there that, oh, so my bull put credit spread is going to look like this, dip right down to 225, and then continue down. I want this to be 225, right? That's where I'm targeting the at the money long. Well, I can't do that. You know why? Because you have to add in the 5-point margin requirement for the bull put credit spread aspect of the put ratio spread, meaning that this break even, as you saw, is going to dip down here, and that's why it's at 220. Your point is still close to 225 where it's trading right now. But if I'm using the at the money to keep the point right at 225, I have to add, I'm sorry, in this case, we'd be up to 232.50. So it's actually 7.5 points. So that break even would be way down below 220. You see what I'm saying? Let's just take a look at it. The 232.5 puts to get the credit at midpoint. And I'm buying there. I'm selling here. Selling 1, buying 2. Now again, the middle of the dead zone is going to be at 225. That's close to where the stock is currently trading right now. Okay? But the break even was extended because why? I increased the strike difference from 232.5 from 230. So we have a 7.5 point loss from the bull put spread, plus still trying to make back the extra costs of that. That's why the break even goes to 217.50. See what I mean? So I'm trying to keep it close to the stock. It went to 227. So I could use the 227.5s and get closer to the current stock price with my little V here. But that's at the buy options. Okay? That's your buy options, which means now you have to find a sell options which counters the double cost of the buys. And that might be deeper in the money than you want. So that lower break even is going to extend because of the difference in the strike prices. The margin requirement of that bull put spread that exists. Okay, so could I structure it the other way? Sure. Okay, here we go. Okay, I could structure it a different way and put the sell option there as well. But again, that's not going to give you the structure you want. You're going to be too far away from that price. Take a look at that. Just one second. I'm going to scroll through here. Okay. Sam does add into our conversation for Todd, Sam does add, there is plenty of time to trade a stock after the earnings as well. What Sam's referring to is then rather than try to time the earnings, The comment came in here also that most of professional traders don't want to trade earnings. They miss the earnings time. They like to trade, oh, that's what his follow-up was. They like to trade after the earnings once the stock has shown its hand, is Sam's thought on that as well. And that's also a valid point. Rather than putting up the money for the long call or putting up the extra money to get in the straddle if you don't think it's going to go in your desired direction, wait till after earnings and see if it's still a good play for a married put. But I understand it. Now you've missed the move, Todd, and you're worried about missing the move. But I think I'd rather see doing it as a straddle perhaps, or just a straight married put, than a short-term long call in that case as well. All right. So I was just looking at the comments there towards the end of that discussion because more comments came in. So we've got Doug, and I've got a very long question from Robert. So I only say that not because it's a bad thing. I say it because it's going to take me some time to read through it when I finally get to it. But Robert's question, Doug's question is pretty easy to answer. Oh, before we do that, let's just take a look here. What if I sold the 227.5s for October and bought the lower strikes that match it? So now instead of buying at the money to get my V close to the stock price and then trying to find the put that would match double this, what if I sold the 227.50 at 430 and then said, okay, this would be $5, so that's out, so it'd be the 220. So what if I buy 220s and sell at 227.50? That's something you could do. Right? You could structure it this way so where Death Valley is further below. But let me bring you up to speed on this here. Let me bring you up to the speed on the concern of this. So here I'm selling the at-the-money 227.50 for 4. I'm only going to pay $4, a little bit below $4 to buy the 220 strikes. So I get this net credit of 66 cents, and I'm pretty much close to that upper break even. Well, this isn't the strategy to do that with, okay? This strategy, this back ratio spread, is a bearish strategy. You want the profits faster. The lower break even here, the upper break evens here, the lower break even, we're talking about being down at 210, 209.50, somewhere in that range, okay? This is a bearish play with a potential profit or small gain to the upside. If you think the stock's going to move this way, but you want some controlled risk, just do a bull put spread. Not this. This is for a bearish play, not to structure so you're closer to the short point to the current stock price saying, oh, if I'm wrong and it goes up slightly, I make this good profit, because now you need it to fall an additional 10, 15 points to get to the break even. This was a bearish play to begin with, not a way to get into a different position, not a way to get into a stock position with a short put if you get assigned. It is a bearish play that you're just trying to complicate with extra options to get a hedge in this direction if you're wrong. All right, that's why you want the structure with the at-the-money buys and try to match it with the sell that gives you the credit in this case, which means this might be 7.5, 8 points apart in our example, and that's why the break-even was 7 points, 6.5, 7 points below the strike price of the calls that we were buying, puts that we were buying. Okay, so Fernando, I hope that answers your question as to why you're structuring it as close as you can. I just used the 225s in my example. I could have used the 227.50 buys and done it from there, but just to make it simple, to answer the first question, we used the 225s and then selling that 230. All right, so for Doug now. This relates to any strategy on power options. Doug wants to know, does the bull put credit screener take into account expected earnings announcement? Absolutely. Pretty much sure all of the defaults do, especially the one that I use. I know for a fact it does. So when I use the bull put weekly search, specifically avoiding earnings between now and expiration. Always avoid earnings when you're doing iron condors, bull put credits, bear call credits, in the money bull call debits that you're looking for that 85-80% probability, and in the money bear put debits. If you're doing at the money bull call debits, you probably have a different trading plan in mind. Any strategy search on power options under the fundamentals, you can check specifically to avoid or select to only see stocks that do not have earnings between now and expiration, or for straddles, stocks that do have earnings between now and expiration. You can also screen by ex-dividend date. And in some of the positions that are a little bit more involved as far as that direction, long calls for earnings, long straddles for earnings, long strangles for earnings, long puts for earnings, you'll have an extra choice here where you can check specifically for earnings dates between now and expiration, not between now and expiration. And if I'm looking at expirations 8 to 10 days out in time, I can say between now and 1 week from now. Okay, so make it shorter than that. Or, again, the ex-dividend date coming up as well. So yes, you can do that in any of the searches. Specifically to your question, the bullput default screen that I use is avoiding earnings between now and expiration. You always want to double check that. Okay, I'm going to say that. Sometimes I've seen it, a customer calls up and says, hey, I was running a screen for positions that expire on September 16th, but it looks like the earnings are coming out on September 15th. And I'll look at my Fidelity account. I'll look at maybe my Ally account, and I'll look at it, and they have a listing that the earnings are between September 15th and September 19th. They don't give a date, they give a range. So it could be the 15th, it could be the 16th, it could be the 19th. It's just that our data maybe read that as it was expected to be September 15th, but no date has been announced yet. That's sometimes one, I'd say 3 out of the total earnings cycle that comes out each time. Maybe 2 stocks or 3 stocks have that happen where they've published a range, but they haven't published an actual date. So you have to figure out which one's the safest and best one to list because of that. We might have accidentally listed the 19th, and it could have been the 19th as well. But if you look at any of the default settings that you pull up, Doug, on PowerOptions or the sample searches, scroll down, initial values, earnings, not between now and expiration. If you don't see that, just go to your Fundamentals tab, click the checkbox for not between now and expiration, verify it, check it, resave the search under your specific name. Now you know that every result that's in there, 99% sure, does not have earnings between now and your desired expiration date. And if it does, it's because they haven't announced a specific date yet. Okay. And of course, do I have it? Oh, I didn't. But one thing you could always verify to do that, remember, Doug, just go to add or remove columns in any search. Those of you doing covered calls, naked puts, bull puts, calendar spreads, you want to avoid earnings between now and expiration, check that box. Anything that you can filter by, remember, down in the search parameter field, down in the parameter field in any strategy, you can also add to your column view. Just click Add, Remove Columns. Go over to our stock-related columns here on the left, and just going to scroll down here. I always miss it. I always try to go to earnings before interest and tax, but I just want earnings date. Check the box there for earnings date or ex-dividend date. And down at the bottom here, oh, sorry, folks. Down at the bottom there, submit and save. You can reorder them as well. Okay, and now we just go back. Yeah, it's a double refresh there. Anyway, we go back, and now I have my earnings date. Okay, so there's one that had one. When you see the negative here, Doug, that means that it just passed earnings the other day. Those of you that might be interested, that was Costco. Just had earnings the other day. But you see ones here, 56 days to earnings, 62 days, and we're looking at an expiration 42 days out in time. And as another feature here, Doug, what you have is confirmed, CONF. Let's run through this real quick, okay? So the earnings date here, 12/5/6, here's what it means, 12/5/2019, that's the expected date, 62 days out. BO, before open, or AC, after close, that's what that means. And this is unconfirmed. What does that mean? It means they haven't released the specific date yet, but based on all of their earnings in the past, the target should be December 5th, and they tip this particular stock opens before the open. And we know that. It's just not confirmed what the exact date is. However, the first one on our list is confirmed right now. The last one on our list is confirmed. Well, the third one is confirmed. Here's another one that's confirmed. That means we know it's been posted. They don't always have to post the exact date 2 months before or after the last earnings. As they get closer to earnings, they'll post a date of when it is. Okay, so for a married put position, I don't really care, but yes, on a bull put I would. But keep in mind, 20 days out, 30 days out, it's likely posted. We're talking about 42 days out in time here. A lot of companies still haven't posted when their earnings are actually going to be. But long story short, yes, any search, you can remove earnings between now and expiration. We talked about the data, how you might want to double check that. Add the column so you can see if it's confirmed, unconfirmed, and even if you want to, see if it's before market or after the close as well. All right, so I was just seeing some of the comments. We're going to talk about Sam's comments, but he also said, just agreeing with what I said is that, spread traders should avoid earnings unless you're doing a synthetic, not a synthetic, but a sort of long straddle or long strangle position with short options in it because you're looking for the movement. You're trying to mimic it that way to lower the cost. All right.